As we kind of closed out video number 2, we were talking about investors and investors being lazy and kind of running to the latest, greatest hot thing. If you've been following my channel for any length of time, you know we've entered the bad time, but I'm personally excited. I wanted to talk to Jonathan about, hey, if you were an investor and you wanted to be a limited partner in deals coming up, and you were either burned or you're hearing about people being burned in bad deals, what should we be doing as limited partners? Because again, there will be assets traded at discounts. There will be a lot better deals done in the next 2 years than the last 2 years, but we're going to hear about all the fear and collapse and crash and all of that. So, Jonathan, if you were talking to a friend or buddy who's looking at being a limited partner in somebody else's deal, what are some things you should ask them to look for to feel better about the GP or perhaps the deal, whatever you want to point them at? What's the first thing?
Well, yeah. Well, actually, the first thing I would say is on a more large, kind of a larger point, which is
Okay.
that the thing to understand is that risk in markets is totally counterintuitive, right? When everybody is doing something and telling you it is a good thing to do, that is when the market is the most risky, right? Because that is when you're setting up for a crash, right? So crashes don't happen after a crash, right? They happen before a crash. And the before the crash is when everybody's telling you there's no crash in sight and this is the greatest thing since sliced bread and it's easy and whatnot. So the inverse of that is now that everybody, the deals, volume has fallen off the table, like everybody's panicked. There's been a big, property values have dropped. That's actually a safer time to be getting into the market than when everybody's telling you it's a good thing. The problem is you have to be strong or be an independent thinker and ignore all the people around you telling you, oh, well, look, the market's down, you shouldn't get in now, right? You have to understand, well, the market just went down, so it's more
Margin
likely
of
to go
safety is
up.
better. Yeah.
That's right. The margin of safety is better. It is more likely to go up after it goes down than it is likely to go down more. I mean, it could, but you've already taken a lot of the risk off the table. So is there a little more risk? Well, yeah. Could it go down further? Yeah. But it's not, you've just taken a lot of that potential energy out of the equation, right? So that's the first thing to understand. But then you're going to get into, okay, how do I look at this deal that this person is bringing me? And the first thing you really got to do is look at the operator themselves or the team,
Yes.
right? You really have to say, okay, whatever this deal is, whether it's, multifamily, a hotel, self-storage, whatever you call it, maybe even office, right? Like, because I'm sure there's going to be some good office deals coming up pretty soon
Yeah. Pretty soon.
because people are scared. But what you want to do is look at the operating team and say, well, what kind of experience do they have? Have they, if they're telling you that this is a value add play and this is what it's going to take to execute it, well, have they done that before, right? And how successful were they, and what problems did they encounter, and how do they overcome those problems? I think you can never be 100% certain, but I think what you want to look at is more kind of like their attitude and their approach, right? So if you ask somebody like, what did you do when you had a problem? And they say, well, we never have any problems on our deals. Well, that's a red flag, right? Somebody who says, oh yeah, well, like on this deal, we had this big problem and this is how we solved it. And this is what we learned. And, we probably won't have that problem again because we know how to avoid it now. But when we have another problem, well, this is how we'll approach it. You want to somebody who is going to be honest with you about what's going on, is going to communicate with you, and is really thinking actively about what could go wrong. Because I think what you see is a lot of people in business who really don't want to think about the fact that stuff could go wrong, right? And if they're not thinking about stuff that could go wrong, then they're not going, like they're going to either miss it, or when it happens, they're not going to be able to deal with it, or they're going to try to hide it, sweep it under the rug, right? What have you. So you want to make sure that you're dealing with somebody who is going to communicate with you and is open to the possibility that things won't go according to plan. So that I think is, so you've got the experience and then you've got the approach, right? Those are the two things on kind of like the sponsor team.
Yeah, the thing that I would also look at, just because I've personally been through this myself, is kind of the debt structure. And really, it's the term when stuff comes due. That can be a forcing function. And I bring that up because I did one seller finance deal one time on an apartment building that was a 5-year term, and I hadn't done those before. And it was shocking how fast 5 years came by. It happened to come by in 2008 in my market, which was horrible, right? The crash was in full effect. I was nervous that the seller would ask for the 100 grand or 120 or whatever it was. Now, thankfully, she understood what we were doing. We just extended the term, but that was a nerve-wracking phone call
Yeah.
going into that. So I would definitely be looking at the debt structure. Understand. I'd want to hear from them how they feel about the debt structure, right? The GP, kind of the plan, because again, as I've shared for the last year, it's the debt that always gets you.
Yeah. Yeah.
Yeah. So I'd want to poke at that.
Yeah, I was going to talk about sort of the deal itself next. So you've got like the sponsor first, and then you've got the deal, right? So you want to look at the deal and see and understand it, right? So you want, like you said, understand the debt structure. We can take that on first, right? What kind of debt have they got? Is it fixed rate? Is it variable? How comfortable do you feel with whatever they've got? How much cushion do they have over their debt service according to their underwriting? And what do they have to do to get there, right? Is it like day one, there's cash flow and they're paying their debt service right away and with a big cushion, and then they're going to undertake a value add? Well, that's pretty safe. That sounds like a pretty good deal to me. Do they have to get to being able to make the debt service? And if so, what are they doing? Are they raising a reserve fund to pay the debt, right? How is the deal structured, and what are the safeguards that are built into the deal to make sure that they can get there, right? So that's a big one. And again, so if you're looking at the debt, what's the term? Is it 2 years of bridge and then they've got to pay that, in this market, or is it a 10-year fixed debt instrument, right? Like, so those things are things to think about in terms of evaluating the risk of the deal itself. And then the other thing that you really have to do is you really got to understand their underwriting, right? And you've got to understand a few key pieces of it, right? And I think the first thing that I would look at is the exit cap rate that they're projecting, because that's the easiest way to manipulate the returns, right? All you got to do is drop that exit cap rate by 25 basis points or 50 basis points, and you can really change the dynamic of the deal. So when they tell you, first of all, you want to see that they're like in their marketing materials telling you what the exit cap rate is that they're projecting. I mean, a great thing to look for is like in their marketing package, are they telling you like these are our underwriting assumptions, right? That's a good sign, because they're telling you essentially like, hey, you can underwrite the deal yourself, right? Here are our assumptions. They don't sound crazy, do they, right? But if they don't disclose them, because maybe doesn't necessarily mean they're hiding them, just might have not thought to disclose them. Ask them like, what is the assumption here? And if you're on a Q&A with them, ask them about their underwriting assumptions. So you want to first dig into that exit cap rate, right? If they are telling you like that they're looking, even though historically speaking, there was an idea that you could get cap rate compression if you like took an asset from a C to a B because people were willing to pay more for a B than a C. There was that made some sense. The problem is now with cap rates have all been compressed between the classes, that's no longer valid, right? So someone's telling you like, hey, we expect to exit at a lower cap rate because we have raised the quality of the asset. I wouldn't buy that, right? So that's kind of a red flag. You want to make sure that the cap rate that they're exiting at is sufficiently high. And you want to find out, like, is there some cap rate sensitivity? Have they shown you in the document, like, hey, this is what happens if cap rates change based on our assumptions, and does it still hang together, right? And so those are things to look for. You just want to make sure, just really dig into their assumptions and make sure that they're not assuming something crazy. Are they assuming, if it's a multifamily deal, are they assuming 98% occupancy throughout the whole period? Well, that would violate all of the underwriting principles.
Yeah, all of history, yeah.
But like, look, you could potentially say if it's New York City, right, where vacancy rate has never gone above 3% since World War II. Okay, maybe it's okay to underwrite a 3% vacancy in New York. But in markets where, historically vacancy has been 7-8%, which is a lot of the country. And in recent years, it's been, 95, 96, but we're looking at like, hey, maybe reverting to the mean here, right? What does it look like if occupancy is down? You want to, so you want to see that kind of, so you want to make sure that they've taken these things into account. You want to make sure they've calculated a break even occupancy, right? And then it's a reasonable, their break even is not 92%, like break even is 75%, which they're probably not going to go down to. So you just want to make sure that they've really thought about these downsides. Again, rent growth. What are they forecasting for rent growth? Are they forecasting 3% a year, which is pretty standard, or 2% a year, which would be even more conservative, or are they forecasting 5%, 6% for the whole, term? They might have a valid reason for saying we're going to get 5 next year because we're going to do all this value add, but 5 every year, well, that's totally unrealistic. So you want to look at those kinds of things as well. And if you can satisfy yourself that this is a person who's sufficiently conservative, not just saying that they're conservative, because
right.
I've never met a GP who said, I'm aggressive, right? That I'm an aggressive underwriter. I've never heard anybody say. Everybody is a conservative underwriter. But I think a lot of people are fooling themselves into saying they're conservative when they're really not. So you want to make sure that they really are and feel satisfied that they've thought sufficiently about the downside and they've built in a margin of safety. And if they've done all those things, if you're comfortable with the operator, you're comfortable with the debt, and you're comfortable with the underwriting and the projections, then I think there's a lot of money to be made in this market, because the deals that are getting done are going to be really
pretty good deals.
Yeah.
The good thing about what I think is coming, first, these are the environments I thrive in, because again, I run away and maybe run away early. Like I sold a building in 19 that I would have made $500,000 if I held it a year. So you could point at me for that. But I do a great job of running away from the herd because I know the bad time is coming. What I want to tell most kind of LPs that are thinking about this is we are going to have more time to think, right? The last couple of years, it was, people were raising $50, $100 million in a weekend. You really didn't have to, before it was closed. I think the equity raising is going to be more time, it's going to take longer. So we're all going to have a chance to think more. You're going to have multiple Q&As. You're going to have all of these things. So I think net, it's the right time to ask these questions. Ask for break-even occupancy. Ask for, what the cap rate is on exit and those things. So great advice. Any closing thoughts on all this?
Yeah, I do. Your point about like selling too soon is really interesting, because, I sold my portfolio in 2019 as well. And I sold it because I thought the market was getting pretty
topping out.
Right. Yeah. And people accuse me of timing the market, right? You can't time the market, right? And the thing is, yeah, you can't time the market, but what you can say is, I see the general trend, right? And the general trend is that things are too pricey and that state of affairs can't last forever. So I'm going to take my profit now, right? And wait and see what happens. Now, people said, we're like, you can't time the market, you can't time the market. And they're right about saying you can't time the market. However, they were actually the ones trying to time the market, because they were trying to hold on to get that last
little bit,
and try to sell exactly before the crash happened. That's what timing the market is. But when you make a judgment that says, I think the market is topping out, so it's time to sell, or I think the market is bottoming out, so it's time to buy, that's not timing the market. That's reading the market, right?
Exactly.
If timing the market is that I'm going to hold out until the absolute bottom, as if you can spot it, or I'm going to hold out for the absolute top, as if you can know when it's happening. You can't. That's impossible. But you can say, historically, things are too expensive, cap rates are too low, this can't last forever, so I'm going to sell. Or, hey, look, cap rates are now higher than the long-term mean, so could they continue to expand? Sure. But if I buy now, am I getting a good deal? Yes. So I'm going to buy. And that's the way I think about it.
Yeah, I'm excited for the next 2 years. Again, I've been, maybe it took a year longer than I thought to get here. It's here. I think it's actually going to last longer than I originally thought. So I'm excited for the opportunities that are coming. Jonathan, where can people find you?
Yeah, well, if you want to, invest with us, please Google Two Bridges Asset Management and fill out the investor form, and we'll add you to our list. And if you want to, sort of hang out and talk multifamily with me on Facebook, you can come to Apartment Investors Club and chat with me there.
Thank you so much. Take care.
Yep.